Okay, so you want to own a rig. Buy the machine, hire a crew, keep the rig moving, and charge an oil company every day it drills. But here's the strange part. A rig can make hundreds of thousands of dollars every day and still destroy its owner's fortune. And here's the question. How can a machine that makes hundreds of thousands of dollars a day still make its owner poorer? By the end of this video, you'll know exactly where the money comes from, why an idle rig is basically a floating mortgage, and why the biggest risk isn't drilling oil at all. Rigs come in three very different sizes. A serious land rig can cost tens of millions of dollars. One 2,000 horsepower land rig contract in 2012 was priced at $26 million. That's roughly the price of a dozen luxury homes in many American cities. And that is the small end. Then you move offshore. A premium jackup rig can cost around $200 million. One documented Pacific Class 375 jackup had a construction price near $198 million. It can work in relatively shallow water, then walk itself between wells. Then comes the monster. An ultra-deepwater drill ship can cost $600 million or more. ENSCO estimated $625 million for one drill ship, including commissioning and integration. That's roughly the cost of building a small skyscraper, except your skyscraper floats. And these aren't machines you simply park in a garage. They are enormous industrial systems, carrying drilling equipment, living quarters, generators, safety systems, cranes, communications equipment, and miles of specialized piping. But here's the hidden cost nobody puts on the brochure. The rig is only one part of the operation. You need certification, insurance, specialized crews, support vessels, maintenance, inspections, spare equipment, mobilization, and eventually decommissioning. And offshore, a rig sitting without a contract can burn through hundreds of thousands of dollars every day. Now we get to the question that actually matters. Why would anyone pay this much for a machine? The answer is simple. You are not really selling a rig. You are selling time. Imagine I own a $10 million machine. You pay me $50,000 every day to use it. Whether you drill 1 barrel or 1,000,000 barrels doesn't directly change my rental fee. I own the expensive machine. You take the geological risk. The industry calls this a day rate. It is simply the price an oil company pays to use the rig for one day. And day rates get enormous. In 2015, ENSCO reported offshore contracts around $114,000 per day for premium jackups. Its ultra-deepwater drill ships were commanding rates around $550,000 per day. That's more than $200 million of gross revenue over a full year if the rig works every day. But nobody gets 365 perfect days. A rig needs maintenance. Wells get delayed. Customers cancel contracts. Weather stops operations. Sometimes the oil company simply doesn't need the rig anymore. That creates the most important number in the entire business: utilization. If your rig earns $500,000 a day, at 90% utilization, that's about $164 million a year. At 50% utilization, it's only $91 million. Same machine, same crew, same steel, half the opportunity. And here's where the economics get nasty. Your costs don't fall as fast as your revenue. A modern offshore rig needs hundreds of specialized systems and highly trained workers. Transocean's 2017 projections used average direct rig operating costs around $130,000 per day. So if your rig earns $500,000, you aren't keeping $500,000. You are starting with roughly $370,000 before corporate overhead, financing, taxes, and major maintenance. That difference is where inexperienced owners get fooled. Gross revenue looks enormous on paper. Cash flow after everything else is a completely different animal. Now imagine the rig goes idle. Revenue goes towards zero. The steel doesn't care. The crew still needs to be managed. The equipment still needs preservation. Insurance still exists. Loans still come due. This is why the industry's secret weapon isn't the rig. It's the contract. A long-term drilling contract turns a gigantic piece of steel into something closer to a subscription business. If an oil company guarantees your rig 3 years of work, your financing becomes easier, your revenue becomes predictable, and your machine has a buyer before it even leaves the shipyard. But here's the part people miss. The oil company isn't buying your rig. It is buying certainty. Now the architecture. A successful rig owner is constantly balancing three things: capability, location, and contract length. A cheap rig in the wrong market is expensive. A brilliant rig with no contract is just a very impressive sculpture. The industry also uses a term called stacking. Stacking means taking an idle rig out of active service to reduce operating costs. Warm stacking keeps a rig closer to ready. Cold stacking shuts down more systems and cuts costs further. The problem is getting back into action can be expensive. Transocean estimated reactivating a stacked rig could cost about $70 million. That's roughly the price of buying 2,300 new cars at $30,000 each, just to make an old machine useful again. And then there's the 5-year inspection cycle. Major offshore rigs undergo special periodic surveys. Transocean's 2017 projections used roughly $20 million per rig as an average cost for those major surveys. So the machine earns money every day. Then every few years, the machine sends you a multi-million-dollar bill. And there is another timing problem. You can spend millions preparing a rig for work before earning the first dollar from its next contract. That means working capital matters almost as much as the machine itself. Now the failure stories. First, Seadrill. In 2017, Seadrill entered Chapter 11 after the offshore drilling downturn collided with an enormous debt load. Its restructuring involved $5.7 billion of secured bank debt and $2.3 billion of unsecured bonds. Existing shareholders were left with roughly 2% of the reorganized equity. The rigs weren't suddenly worthless, the financing was. Seadrill had built an aggressive fleet during the boom. When day rates collapsed, the debt remained. The machines could still drill, they just couldn't earn enough to satisfy the capital structure. That's mistake 1, confusing a valuable asset with a safe balance sheet. Now mistake 2, Hercules Offshore. When oil prices collapsed and offshore activity contracted, utilization and day rates fell sharply. In August 2015, Hercules filed Chapter 11. Its bankruptcy records showed liabilities above $1 billion. The company emerged from bankruptcy later that year, but the economics had been brutal. 6 rigs sold during 2015 generated only $4.5 million of gross proceeds. Think about that. 6 drilling rigs, $4.5 million. The equipment didn't suddenly become scrap metal. The market simply stopped valuing the capacity. And that is the real danger of owning a rig. Not that the machine breaks, that the market stops paying for it. So let's pull the numbers together. Imagine a smaller land rig operation. You spend $26 million on a new 2,000 horsepower rig. Suppose you secure a $50,000 daily contract and operate 330 days a year. That's $16.5 million in annual revenue. If your all-in operating margin were 25%, you'd produce about $4.1 million in operating profit. Ignoring financing and taxes, that's roughly a 6-year simple payback. Not spectacular, but understandable. Now go offshore. You spend $625 million on an ultra-deepwater drill ship. Suppose you secure a $500,000 day rate and achieve 90% utilization. That's about $164 million in annual revenue. If operating and corporate costs consume roughly half, you could have around $82 million before financing, taxes, and major capital expenditures. That's a theoretical payback of about 8 years. And that word theoretical matters. One bad contract gap can erase years of profit. One major repair can consume an entire year's cash flow. One collapse in oil prices can turn a premium rig into $1 billion problem with a very large anchor. And leverage makes the problem even sharper. Borrowed money can make the returns look spectacular when day rates are high. But when utilization falls, debt doesn't politely disappear with the revenue. The biggest operators understand this. Anthony Petrello helped build Nabors into one of the world's largest drilling contractors by focusing not just on owning rigs, but on technology, fleet efficiency, contracts, and cost control. Nabors itself emphasized fleet technology, automation, efficiency, and disciplined cost reduction during the downturn. And that's the paradox. A rig looks like an asset. Economically, it's a leveraged bet on utilization. When the rig is contracted, the steel becomes a cash machine. When the contract disappears, the same steel becomes a liability. So if you ever want to own a rig, remember the rule. The rig doesn't make the money, the contract does.